As U.S. stocks have done pretty well recently, emerging market stocks have had a rocky ride, doing badly, doing well, then going through a rough patch. But there may be some opportunity right now. I'm Jack Otter, editor of Barron's.com. I'm here with Heidi Heikenfeld, who is the manager of the Oppenheimer Emerging Market Innovators Fund. We're going to talk about those innovators in a minute, but first of all, could you just give us sort of a big picture view of what's happening with emerging market economies and stocks?
Sure. So as you know, there's been several years of underperformance in emerging markets that turned around this year, and we've seen a rally in the stocks. They've done really quite well. Brazil was the leader amongst all of the stocks because of the political changes after the President Dilma Rousseff was impeached. So those stocks have done very well. We've also seen a lot of growth in the value area, particularly large cap value, and there's been a big growth in metals and mining.
Metals and mining and commodities are what emerging markets are so often associated with, but of course that leads to booms and busts. So in good times it's great, and other times it so much relies on China. But you're looking kind of in a different space of emerging markets. Can you explain where you go hunting for good stocks?
Sure. So the commodities and the real estate, they can tend to be very cyclical. So they can be boom and bust. And for that reason, I tend to stay away from them. And I'm focused on small and mid-sized companies that are growthy in orientation. And what I think people misunderstand about emerging markets is that it's only commodities, or that it's only labor arbitrage business models. They have cheaper workers than we have, and so companies move their businesses there. But EM is really so much more than that. And where I've found a lot of great investments have been in intellectual property sectors of the market, in healthcare, in technology, and consumers. What we're seeing is entrepreneurs leveraging a talented workforce to develop products and services that really meet the needs of their local environments. So we think over the long term, the structural growth will not be in the commodity space, but will actually be in these intellectual property type sectors.
And what sort of things are they building?
Well, healthcare, I think, is a great example because there are a lot of companies that are developing new drugs, or they're developing copies of biological drugs. As an example, there's a drug called Herceptin that's used to treat breast cancer in women. It's sold in the US, and then it's sold in some of these emerging markets as well, but at very high prices. As the patent comes off of Herceptin, we've seen Indian and Chinese companies able to make exact replicas of this drug. They sell it into their local market, and it makes for the first time that Chinese women and Indian women can take advantage of a real drug that can treat their breast cancer. And also, these drugs have been filed for approval with the US FDA. So these drugs will get cheaper in the US, they'll get cheaper in Europe, and we'll have emerging market companies to thank for that. So I think that's exciting.
Now, emerging market stocks, if you look globally, tend to be as a whole cheaper than the rest of the globe. I mean, if you look at various standard measures of valuation. But of course, a lot of that is actually based on the commodities and those things that are super cheap right now, and the low price, or until recently, low price of oil. Your companies are more expensive, but you point out that when you actually compare them to their growth rates, they look like a real bargain.
Yes, so I'm a growth investor, and this is the small and mid-cap space. And so if you think about the valuations that you would find on the NASDAQ, my companies actually can look relatively inexpensive, but you can't use just a PE to look at growth companies. You should look at them on a PEG basis. You should look at them compared to the growth rates that they can provide. And I believe that I pay very fair prices for extraordinary companies. I would mention one other thing. When you invest in biotech companies or you invest in tech companies, we think about companies that are non-profitable because that's what we see on the NASDAQ. But in emerging markets, it's quite difficult to list a company if it's not profitable. So the companies that we invest in those spaces are profitable because they're allowed to sell their products in their local economy before they expand to the rest of the globe. So that makes them different.
One more point on the PEG. Generally in this country, when you're thinking about value versus growth, you think about stocks with a PEG ratio lower than 1 as a value stock. You're a growth investor, and yet, am I right that your portfolio's PEG is actually just below 1?
Yes, it is. It is. We pay fair prices for extraordinary companies.
Thanks very much.
Thank you.